Tyler Laundon, Chief Analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, here with your Cabot Weekly Review. It is Friday, June 6th, and we are coming on about 10 minutes until 12 o'clock Eastern Time. So it's interesting, yesterday, getting to midday, I was thinking this video would be pretty straightforward, talking about, Trump, Xi call, maybe some ADP payroll numbers that came out this morning, but boy, was I wrong. So Trump and Musk's big, beautiful feud erupted midday yesterday. Of course, that sent the market lower. Shares of Tesla fell over 14%. Apparently, that drove about 40% of the S&P 500's half percentage point decline yesterday. The impetus for this very, very public back and forth was, of course, the big, beautiful bill that Trump's trying to get passed, and which Musk has called a disgusting abomination for increasing the national debt. We wake up early this morning, Friday. It sort of sounded like these guys, or at least their aides and their advisors, were trying to de-escalate the situation with a potential call scheduled for today to broker peace. But then later this morning, Trump downplayed that potential. So we'll just have to see what happens there. Moving on to what really was going to be the bigger news item of the week, the 90-minute Trump-Xi call on Thursday morning. Trump called it very good. Each leader invited the other for a formal visit, and apparently trade teams will meet soon. Nothing concrete to report. Other than that, there continues to be an apparent willingness on both sides to negotiate. We've all heard that China's rare earth export restrictions is one of the major wrinkles that needs to get ironed out. So hopefully we'll get more clarity on that over the weekend or early next week. If we turn to the big macroeconomic data of the week, it was an important one for jobs. There's been a lot of debate lately about the labor market, since softening in that market would likely give the Fed more room to cut rates sooner rather than later. May's ADP employment report came out Wednesday. It was weak, but the May non-farm payroll report this morning was strong. So kind of a mixed bag there. Next week, we will get the CPI inflation reading on Wednesday, and then PPI on Thursday, followed by the University of Michigan consumer sentiment and inflation expectations for June on Friday. So, of course, all of that data is going to fire up new speculation about what the Fed will do at the June 18th meeting. But really, is there any cause to speculate? There's essentially 0% chance of a rate cut in June. With the European Central Bank having cut again this week, bringing it to, I think it's 200 basis points worth of cuts. I think that the Fed's resistance is going to put Powell and the Fed in Trump's crosshairs again. I've already seen a few headlines to that effect this morning. But as we've seen lately, and much more so than in April, Trump does not, at that point, he didn't really seem to care what the market thought of his policies and his public comments, and that's shifted over the last month and a half. Definitely seems more of an effort to tamp down the rhetoric, to be a little bit more market friendly, if not initially, then in follow-up comments. So hopefully there won't be a major dust up with Powell. I think the Fed members have been pretty clear that they're not going to take action until they can assess the impacts of the administration's tariffs, and the latest job numbers really don't change that trajectory. Best chance for a rate cut continues to look like maybe September, with current market odds suggesting maybe 225 basis point cuts this year. So we'll just have to see how that all plays out. But back to the market, we're up a little bit less than a percentage point here on the S&P 500. Market has been remarkably stable lately. I think investors have seemed to come to an understanding that there's a lot of noise out there, but what really matters is what the economy is doing, and on that front, it is a mixed bag. Despite the market's resilience, the investor sentiment numbers are still pretty low. The latest bull-bear ratios, I think, was yesterday. So bullishness is pretty low, which is bullish from a contrarian perspective. So I guess let's get into some stocks. Going to keep it pretty tight today, talk about 3 companies rather than spreading things all around. I think all of us who have been watching the market closely have seen that there are a lot of stocks that have a ton of momentum that are just going crazy to the upside. We're not going to get involved with talking about any of those today, and likewise, I also don't care to talk about any dogs. So what I've tried to do is pull out 3 stocks that I think have the potential to do well in the coming months. Right now, of course, we'll just have to see what happens. But and as always, if you do get involved with these stocks, that's on you. Do your own research. I'm just trying to point out some things here that look interesting to me. Before we jump into those, just a real quick look here at the S&P 600 small cap index, which has come up. Maybe it's hit a little bit of resistance, but there is a calendar effect here that we're potentially getting into one of the stronger periods of the year for small caps. So hopefully that will play out. It has been obviously a very, very disappointing year for the small cap asset class this year, so far at least. And quick look at what the 10-year yield is doing. Came down over the last couple of weeks, but back up today. Definitely would like to see that below 4.4%, but it is what it is. So, all right, on to stocks. So the first one here is FTA Infrastructure. Ticker symbol is FIP. Market cap of 740 million. So this is a small cap infrastructure company. You probably have never heard of it. Develops and operates transportation and energy infrastructure businesses in North America. It owns a railroad business, a couple of ports and terminals, and a power and gas terminal. As you can see, obviously the stock, kind of flatlined last fall and then had a really bad end of 24 and beginning of 25. But it turned around right around Liberation Day here, right around April 11th, and it has been going up since. And what kind of jumps out at me is this isn't just a FIP story. There are also some other infrastructure stocks like Brookfield Infrastructure, ticker symbol is BIP, where momentum has come back. So kind of interesting to find a stock that's doing well, that's been beaten down in a group that seems to be recovering. There are a lot of expansion projects going on at FTA Infrastructure. Way too many to cover in detail, but one potential catalyst I will mention is that the company could potentially be a beneficiary of the proposed U.S. steel takeover by Nippon. FIP acquired its railroad business Transtar from U.S. Steel, and U.S. Steel still accounts for the vast majority of revenue from that business. Management has said that the takeover could open the door for the business to take on a lot of projects for other customers. That's something that U.S. Steel has very much discouraged over the years. So kind of a little bit of a side story there. I'm not sure if that potential is helping the stock, but it is an interesting story that a lot of people, or I would venture to say hardly any investors are really aware of. Very little analyst coverage here. So that is FIP and FTA Infrastructure. Moving on to a name that's been hot and cold over the years since it came public, but this is Lemonade. Ticker symbol is LMND. Market cap is currently just shy of 2.8 billion. Lemonade is a technology-driven insurance company. They offer a whole bunch of, the typical personal lines like renters, homeowners, car, pet, term life. It's kind of an interesting story when you go to their website. I was just in the market for insurance, so this one was, popped up, and I got some quotes from them. They focus on an AI-driven digital user experience, and that includes both from setting up a policy to filing claims. They also have a bit of a different premium model than other insurance companies. Lemonade takes a fixed percentage of premiums as a fee and uses the rest to pay off claims. They say that a portion of the leftover funds can be donated to causes chosen by policyholders, but that is, of course, subject to board approval. So revenue was up 23% last year, and it was up again 27% in the first quarter of 2025, and is expected to grow by 27% this year and 30% next year. Profitability, definitely a challenge here. The company lost about $3 per share last year and is expected to lose about $2.72 this year. It's an interesting one because there are analysts like those at Morgan Stanley which say that the stock is going to be held back until it can get on a path to profitable growth. Management is apparently taking steps to reduce expenses and streamline operations, but they are also aggressively pursuing growth in the car insurance business. I think trying to get to like 10 times growth or 10x revenue that they've historically had. So that might drive higher losses in that line, but also considerably higher revenue. And at the time of the Q1 report, management did raise full year revenue guidance. So based on the stock's trajectory since the Q1 report, seems like top line growth is what investors care most about, at least right now. So Lemonade could have some upside surprise potential based on revenue. And if they are able to control cost and get that EPS number really trending in the right direction, then maybe they could get a little more analyst support as well. All right, last but not least is Fiverr. Ticker symbol is FVRR. Company has a market cap of 1.2 billion. We've talked about this one in the past, I think. But, you know, you need a refresher on it. So Fiverr has an online marketplace. They connect freelancers with businesses looking for digital services. It was founded by a serial entrepreneur. You know, we're talking things like graphic design, writing, video editing, website development, social media marketing, that kind of thing. It was a really, really fast growing company during the pandemic. Revenue was up 50 to 70%, maybe even a little more for a couple of years. But then things really slowed down afterward, and Fiverr has not grown by more than 10% for a couple of years. However, in Q4 of last year, revenue was up 13%, and then it topped 14% in the first quarter of 2025. So maybe it's turning the corner, seeing a little more growth. Management on the Q1 call talked about, you know, it's not an amazing market right now for the company, but it is making some strategic investments in some more complicated services and artificial intelligence to drive growth. And it's also finding some traction with larger customers. I think the downtick in consumer sentiment, small business sentiment really hurt the name. But if we could see small and mid-size end of the market come back, that would be a good thing for Fiverr. And also some analyst support out there. So following the Q1 report, both Citigroup and Goldman turned more bullish on the name. So obviously Fiverr stock is coming up against some overhead resistance here. You know, who knows what will happen? It could turn around, head south. It could just stall here, but a break above 36 would certainly be bullish for the name. And I expect that we would need to see a good Q2 earnings report, or at least some other good fundamental news in order to drive that breakout. All right, guys, that's it for me today. I hope you have a nice weekend, and we will be back in touch next week. Take care.